In the fall of 2001, one of the most admired companies in America collapsed in a matter of weeks. Not months, not years, weeks. $60 billion in value, gone. 20,000 employees watched their jobs, their pensions, their entire futures disappear almost overnight. Wall Street had called this company a revolution. Fortune magazine had named it America's most innovative company 6 years in a row. But behind the glass towers and the glowing headlines, something else was happening. A lie so large, so carefully engineered, that it would take down not just a corporation, but one of the biggest accounting firms on earth with it. This is the story of how a company built an empire on paper, and how one set of numbers that were never real, brought the whole thing down. How does a company worth $60 billion vanish in less than a month? How did some of the smartest people on Wall Street, the analysts, the auditors, the regulators, miss it? And how did a handful of executives convince an entire industry that they had reinvented capitalism itself? The truth was far worse than anyone imagined. And it started with a simple idea that, on paper, looked like genius. In 1985, a merger created a new kind of energy company. Two regional pipeline businesses combined to form something bigger, a company that would soon call itself Enron. At the helm was Kenneth Lay, a former economist with connections in Washington and a talent for building relationships with the people who mattered. Lay didn't just want to run a pipeline company. He wanted to build an empire. Enron didn't just move energy. It began to trade it, buying and selling contracts for natural gas, and later electricity, the way Wall Street traded stocks and bonds. The man who helped turn that idea into a machine was Jeffrey Skilling, a former McKinsey consultant with a reputation for radical thinking. Skilling believed Enron shouldn't own physical assets at all. He wanted Enron to be an idea factory, a company that made money not by producing energy, but by predicting and trading it. It worked. Enron stock soared. Revenues exploded past $100 billion a year. The company was ranked the 7th largest in America. Its headquarters in Houston became a symbol of the new economy: glass, steel, and unlimited ambition. Young traders were hired straight out of business school and handed extraordinary bonuses for taking extraordinary risks. Enron didn't just do business. It performed success. Investors believed in it. Employees believed in it. Analysts on Wall Street believed in it. But what nobody realized, not the public, not most of Enron's own employees, was that the profits everyone was celebrating were not entirely real. To keep the stock price climbing, Enron needed to keep reporting bigger and bigger profits every single quarter. The problem was that many of its long-term energy contracts wouldn't actually generate cash for years, if ever. So Enron adopted an accounting method called mark-to-market. Instead of reporting profit as money was actually earned, Enron could estimate future profits from a deal and book that entire amount immediately, the day. But that was only step one. To hide what mark-to-market couldn't cover up, Enron needed something even more elaborate. Then came the second layer of the deception. Enron's chief financial officer, Andrew Fastow, built a web of off-the-books partnerships, special purpose entities with names like LJM and Chuko. These entities allowed Enron to move debt and failing assets off its own balance sheet, hiding losses that would have alarmed investors if anyone had seen them. Fastow wasn't just managing these entities for Enron. He was personally profiting from them, pulling tens of millions of dollars into his own pocket through side deals that most of the board never fully understood. Enron's auditor, the accounting giant Arthur Andersen, signed off on these structures year after year. Investigators later discovered that Andersen wasn't just failing to catch the fraud. Some of its own partners were helping structure it. Inside Enron, a culture took hold that rewarded aggression and punished doubt. Employees who questioned the numbers were pushed out or silenced. Skilling introduced a brutal performance review system employees nicknamed Rank and Yank. The bottom performers were fired every 6 months, creating an atmosphere where nobody dared say the company's success might be an illusion. This was only the beginning of what would unravel. For years, the illusion held. But illusions built on lies have a shelf life, and Enron's was about to run out. In August 2001, Jeffrey Skilling abruptly resigned as CEO after only 6 months in the role, offering vague personal reasons. It was a warning sign few outsiders understood at the time. Then, an Enron executive named Sharon Watkins sent an internal memo to Kenneth Lay, warning that the company's accounting practices could cause it to implode in a wave of accounting scandals. Reporters at the Wall Street Journal began asking pointed questions about Enron's murky partnerships. The company's own explanations grew more confusing, not less. In October 2001, Enron announced a massive third-quarter loss and revealed a reduction in shareholder equity tied to those off-the-book partnerships. Investors panicked. The stock, which had traded above $90 a share at its peak, began a freefall. Within weeks, the Securities and Exchange Commission opened a formal investigation. Enron admitted it had overstated its profits for years, forcing it to restate earnings going back to 1997. Credit rating agencies downgraded Enron's debt to junk status, triggering repayment demands the company could not meet. On December 2, 2001, Enron filed for bankruptcy, at the time, the largest corporate bankruptcy in American history. 20,000 employees lost their jobs. Many had their retirement savings tied up in Enron stock through the company's 401k plan, and watched those savings evaporate along with everything else. Arthur Andersen, one of the Big Five accounting firms in the world, was convicted of obstruction of justice after its employees were found to have shredded Enron-related documents. The firm effectively collapsed, and 85,000 employees worldwide lost their jobs, most of whom had nothing to do with Enron at all. Kenneth Lay was convicted of fraud and conspiracy in 2006, but died before sentencing. Jeffrey Skilling was convicted on multiple counts and sentenced to more than 20 years in prison. Andrew Fastow pleaded guilty and cooperated with prosecutors, serving 6 years. The company that had once been called America's most innovative business became the textbook example of corporate fraud. Enron's collapse didn't just destroy a company. It rewrote the rules of American business. In 2002, Congress passed the Sarbanes-Oxley Act, one of the most significant financial reforms in U.S. history, designed specifically to prevent another Enron. It forced executives to personally certify their company's financial statements and imposed criminal penalties for fraud. But the deeper legacy of Enron isn't legislative. It's psychological. Enron taught the world that a company's stock price, its headlines, and its reputation can all be an illusion, and that the numbers on a page are only as honest as the people who write them. Empires rarely collapse overnight. They collapse one decision at a time, until the day the truth can no longer be hidden. And somewhere, right now, another company is making that same first decision, believing, like Enron once did, that nobody will ever find out.